So if you think the goal is to win more trades, it sounds right. Win more, make more. It's simple, right? But if that were actually true, traders with 70% win rates would never blow accounts, but they do, and that they do that on the regular. So something doesn't add up, and today I want to show you exactly what that is. The house does not predict an outcome. It exploits a mathematical edge over thousands of repetitions. So think about how a casino actually makes money. They don't know which way any individual spin goes, and they're not trying to. What they know is that the math is slightly in their favor every single rep. And if they run enough reps, they always will come out ahead. Now that's not luck. That's an edge that runs at scale. And traders who consistently get payouts from funded accounts are doing the same thing. They're not trying to nail every single trade. They're running a system where the math works in their favor over a large enough sample. And that's the game that we need to be playing. Not focused on the entries, but focused on the math. And we want to focus on the expectancy formula. So here, this number actually tells you whether your system will make money over a period of trades. As you can see, a win rate of 45% and a loss rate of 55%. If you calculate it out, it shows that you have a positive of $80 per trade. This means every trade that you take, on average, you will make $80, even though you're losing more than you're winning. And that's the number that will matter here. It's not the win rate, it's the expectancy. Because if that number is positive and your sample size is large enough, your account will grow over time. If it's negative, it doesn't matter how good your entries are or how you trade, you will lose. Every risk to reward has a break-even win rate. This is just the minimum win rate you need to make money or to not lose money. At a 1-to-1, you need 50% just to break even. At a 1-to-2, you need 33%. 1-to-3, 25%. 1-to-4, 20%. So at a 1-to-3, you can be wrong 3 out of every 4 trades and still be profitable. Most traders don't actually sit with that long enough to think about how that should affect their trading. A 70% win rate with a poor risk to reward will bleed your account and you will just eventually blow it. A 30% win rate with a strong risk to reward can compound your account and get you consistent payouts over the long period. Win rate is almost useless as a standalone number, but expectancy is what we should really be focusing on. So you can see here, Trader A has a 65% win rate, while Trader B has a 35% win rate. Over a large period of trades, you can see that Trader B's account is growing. They are getting payouts and making money, while Trader A is just break even or blowing their account. Trader A has small winners and large losers. The win rate looks fine, but the math doesn't work here. While Trader B has large winners and small losers. So here the math works despite losing most of their trades. They lose 3 out of 4. And you can't see any of this from 10 trades or 20. The edge does not really show itself until you have volume. And this is the problem because most traders are making strategy decisions based on tiny sample size because prop firms force you to do this all in a short period of time. A standard prop firm evaluation is 10 to 30 trades, and that's not enough data to know if your system genuinely works. At that sample size, variance is dominating you. It's literally just destroying you. A losing system can look completely profitable, and a winning system can look horrible like it's failing, as you can see. The law of large number needs hundreds of trades before experimental results start approaching the actual edge. So if you've ever taken 4, 5 trades and you hit a rough patch and this decides you to switch your approach, then there's a real chance that you abandoned something that works because you don't give it enough of a sample size. And this is where it comes into short evaluations, which prop firms guarantee. This measures your variance more than they measure skill. So short evaluations measure variance more than they actually measure skill. And traders who understand this are not blowing accounts constantly. They know that the math requires room.
I wanted to be a little bit more clear about what I mean, but as you have a small number of trades, there is a larger range for how profitable you will be, meaning you can be a lot less profitable and a lot more profitable, and it all guarantees on your luck, on the variance. As you get closer to a higher volume of sample trades, then you get closer to your true edge, and this is where you want to be.
I just wanted to point out a pretty good deal I noticed lately. So Lucid Trading's having 40% off 5 accounts max using code DAR. And they have really good prices that make it a low barrier entry to the futures market. $70 to $160 with no activation fee is just kind of crazy. Now they also make this really fun environment so you can get lots of free accounts, deals,
by just playing their system. As you can see, they have a trader leaderboard and sorts of things like that. But using this deal has been pretty good for me lately.
And they give it that room. So prospect theory is basically that humans feel losses about twice as intensely as the equivalent gain. So a $100 loss hurts roughly twice as much as a $100 win feels good. So what happens when you're in a live trade on your funded account? Let's say you're in a win. You've taken a long on NQ and you're up. Your brain is telling you to clock it in, maybe before your take profit. Lock it in before it disappears. You close at $50 instead of your planned $150. Now on the other side, you're in a loser. Your brain is going to tell you again, hold. It'll come back. Don't realize that loss. You hold. That $75 stop now becomes a $250 stop. So trade A, you lost out on a potential $100, and trade B, you lost out on $175. That's not the strategy failing here. That's literally behavioral interference systematically shrinking your edge on both sides simultaneously. And that's why you're blowing accounts. Every month, go back through your last 50 closed trades on the minimum. Calculate your actual win rate, actual average win, actual average loss. Most traders who do this for the first time find out that their planned risk to reward of 1 to 3 or 1 to 2 is actually just 1 to 1.3 or 1 to 2. So that gap is that prospect theory we just talked about running in the background every time you trade. And if your expectancy is declining, the strategy can usually just be fine, but what's broken is your execution. And that data that we just looked at, this tells you this is the red light shrinking, this is the car light. This is the same framework, but now inside the prop firm structure. A strategy that works on your personal account can be mathematically unlikely to survive a funded evaluation because the rules change the math. You have to account for them. So a $3,000 profit target with the same drawdown, this gives you 6 losses of $500 before you're out. That means your expectancy needs to reach the $3,000 before you hit 6 consecutive losing trades. And most traders never run this before they buy in. They just start trading and see what happens. The ones who will actually pass consistently and get payouts calculate the minimum viable expectancy before they take their first trade. 3 questions before you actually know if you have an edge. Answer these 3 and then you can start trading your live capital. 1, is your expectancy positive across the last 50 trades? Remember that formula, win rate times average win minus loss rate times average loss? Well, if that number is negative, you don't have an edge. It doesn't matter what the chart looks like, you just don't have an edge. 2, is your realized risk to reward within 20% of your planned risk to reward? So remember, if you're planning 1 to 3 and you're realizing 1 to 1.4, you're not executing the strategy, you're executing your worst version of it due to that prospect theory. Lastly, is your win rate above the break-even threshold for your risk to reward? If not, then every trade you take is making the account smaller on average. If all 3 of these check out, even if one is unverified or whatever, you still can paper trade. This shift is actually what matters. It's not a technique. It's stopping the obsession with win rate and starting to think in terms of expectancy. Go pull your last 20 trades, calculate this, and see, does the math work in your favor? And if it does, give it volume. Trust the system. Be confident. Let that edge play out. And if it doesn't, then you know exactly what to fix. It's usually more useful than any setup breakdown you can find.